epic 3-week rainstorm. We got 26 inches of rain in 3 weeks.
Wow, that's quite a bit.
It is a lot. Anyway, let's talk about the big plays for 2023, or better known, where is the bear? Yeah, everybody came into this year looking for the greatest crash of all time, except for me. We came in long and just absolutely piled on the longs in the first day of the year. And as a result, we are up 22% so far in January. So hello, everyone. I'm John Thomas, the Mad Hedge Fund Trader, broadcasting to you live from Silicon Valley. So take out your pen and paper to take notes or start typing into your smartphone, because what I'm about to tell you will blow you away and change your life. Or I am in the early retirement business, your early retirement. Why listen to me? Well, I have 50 years of experience in the global financial markets. I'm not going to update that number anymore because I don't want to appear too old. 10 years as the economist correspondent in Tokyo, Japan, and later the White House. 10 years running the international equity division at Morgan Stanley. Marine Corps combat pilot in Desert Storm. 10 years running the first international dedicated hedge fund. 5 years fracking for natural gas in Texas. 15 years now publishing the Diary of a Mad Hedge Fund Trader. I am one of a handful of founders of the modern hedge fund industry who is still working. Most of the rest are dead now. So let's go flying. All right, that was me last summer flying an 80-year-old Battle of Britain Spitfire over the White Cliffs of Dover, if you don't recognize the scenery, and 70-year-old pilot flying an 80-year-old airplane. What could possibly go wrong? At least I didn't waste my time. I got a fresh renewal of my British combat aerobatics license, which is, you never know when that's going to come in handy, given the state of aviation these days. Of course, the other reason to listen to me is our performance. This is our trailing one-year return as of Friday, up 107.27%, trailing one-year return versus down 15.67% for the S&P 500. This is a daily audited return by an independent third party. We basically killed it last year. It's almost impossible to do better than this. We essentially shorted every sell-off and bought every dip. And you do that often enough and you're up 107%. So who is John Thomas? Well, let me talk a little bit about my background since you're going to be with me for a few minutes. My family origins are very humble, growing up as the oldest of 7 children on a remote farm in Southern California. I lived the all-American childhood playing Little League baseball and becoming an Eagle Scout. There wasn't much to do in rural California in the old days but hunting, so I picked up a job as a paper boy for the Los Angeles Herald-Examiner. I found the stock pages, bought IBM at $20, sold it at $30, suddenly found a far better way to make money than delivering newspapers off the back of a bicycle. By the time I was 16, I earned enough money to fly to Europe and hitchhike around the continent. By the age of 17, I visited more than 50 countries and spoke 4 languages. At UCLA, I majored in math and DNA research, which landed me a job at the nuclear test site in Nevada. Their yield didn't mean interest paid, but millions of Russians killed. I didn't see much of a future in that, so the government sent me to Southeast Asia for a few years of intelligence missions, where I learned how to fly and jump out of perfectly good airplanes. There I advised the militaries of America's Asian allies. As the war wound down, I became a foreign correspondent for The Economist magazine in London. When they learned I had a math degree, they switched me over to covering the Asian economy and the stock market. Ta-da, stock market. Of course, research in those days meant carrying a 45 caliber World War II Sten gun. And at the end of 10 years of government service, I ended up with this box of medals and pilot's wings, which I trot out once a year on Veterans Day. As a foreign correspondent, I covered China during the Cultural Revolution, was the first American to visit North Korea since the Korean War, and covered the rest of the continent all the way to India. I figured out very quickly you didn't have to be that smart to make money in the stock market, so I got into the industry, joining Morgan Stanley. After 10 years there, I started my own hedge fund. There's my original ID card from 1983. And yes, the years have been cruel. Yep, that's what I look like 40 years ago. And that's me losing the All Japan National Karate Championship 50 years ago. Warning, do not enter a karate final with a broken wrist. I rapidly became the top performing hedge fund of the 1990s, eventually bringing in a 1,000% return in a decade. Then the money really started to pour in. It's an understatement to say that when your income goes from the thousands to the tens of millions, it really has a big impact on your lifestyle. You get to buy the latest hot car, fly your own private plane around Europe, go marlin fishing in Mexico, and collect vintage Rolls Royces for fun and profit. That's my 1925 Silver Ghost. I sold my hedge fund in 2000, retired to go into the oil and gas industry. After making a quick killing there, I missed the stock market and started the Diary of a Mad Hedge Fund Trader in 2008. I now spend my days pursuing my first love, finding winning trade alerts, but now I do it from my 3 mansions in San Francisco, Lake Tahoe, and Zermatt, Switzerland. And I've quit turning millionaires into billionaires. There's far more satisfaction and challenge, by the way, I should say, leveling the playing field for the average guy and teaching them how to trade, and that includes you. If I can take a $50,000 account and turn it into $500,000, that is more job satisfaction than I could get anywhere else. However, every silver lining has a cloud. 2021, I paid $8.2 million on $22 million in trading income, and I'm afraid to see what my 2022 tax return is going to look like. Fortunately, that is months off. In the little free time I have left, I pursue my other love, flying vintage aircraft on weekends. You see an old plane flying loops over San Francisco these days, it is probably me. Of course, the ultimate luxury is to give to those who need it. As a Marine Corps veteran, I volunteer for grief counseling for widows and orphans and am a major donor to wounded warriors. When wildfires hit California, I visited the main evacuation centers and handed out $10,000 worth of Target gift cards. If you look here, I'm visiting my in-laws' house. They were sifting for their sifting through the wreckage, looking for a wedding ring, which they eventually found because it was made out of platinum, which has a much higher melting point than gold. That's one of the little tidbits you learn after trading commodities for 50 years. There is a method to my madness. The market is now pricing in only a 25 basis point rate hike on February 1st, driving stocks higher, especially interest rate sensitive tech stocks. And as it turns out, a lot of stocks are interest rate sensitive. That's why so many things have been going up. A House of Representatives intent on a debt default has capped bonds for now and possibly through the summer. Energy is plumbing new lows on Russia failures, warm weather, and a supply glut. Only a China post-COVID recovery can save it. Gold and silver delivered a major upside breakout that probably will continue for the rest of the year. 2023 could be the year of commodities. US dollar has topped and will be weak for a decade. Look for the S&P 500 to reach 4,800 by the end of 2023. Oh, and the volatility index is fallen all the way down to 18, saying that this rally could continue for a bit. Global economy is struggling. Recession risk is falling from 98% probability to only 73%, according to JP Morgan. Tech layoffs have topped 70% or 2% of the tech workforce, but all of those people are getting higher paying jobs at the rate of 2 to 1 as soon as they hit the street. Fed may retreat to a 25 basis point hike only instead of 50 in their rate hike next week. China is back with a 3% GDP print for 2022, and their reopening is accelerating, and that'll be good for all of us. Wholesale prices are dropping. U.S. consumer inflation expectations are falling, and inflation will likely drop to 5% in a year, according to the New York Fed, or 4%, according to the Mad Hedge Fund Trader. Who will be right? We shall see. Stocks appear are much better than they appear. This won't be as bad as the last one, or so the bulls have been piling into stocks since January 3rd. The weakness in tech stocks actually understate the ballistic moves in value, metals, precious metals, and financial stocks, which we are long. Banks disappointed on earnings, smacking stocks big time. 2023 is still seeing a massive short cover and has been up almost every day this year. But longer term, we're still stuck in a range until the Fed starts actually dropping interest rates. Commodity plays will lead, oil will lag. Financials will also be a strong sector with biotech as the safety trade. Netflix blew it away with 6.7 million new subscribers, taking the stock up 7% and up 125% from its May low. So look for a terrible first half, strong second half scenario to continue. So this is the bull case for stocks. This is what's in the market already. High inflation, an oil shock, a COVID spike, labor shortages, supply chain headaches, Fed interest rate rises, quantitative tightening, and poor earnings. What happens next in the market? Well, plunging gasoline prices, plunging commodity prices, stabilizing supply chain, record low 3.5% unemployment, better than expected earnings, 1.25 trillion in stock buybacks, soon to fall interest rates, and a weak dollar. This is our market timing algorithm, and it gives ranges on where we expect stocks to move in the short term. It is 95% accurate. And after calling this bottom right here, we look for it to top out right around the 410 to 415 range, and then go back down to the bottom again and test the bottom of the range. And if the Fed doesn't raise by 25 basis points, if in fact it raises by 50, or we get another rise in inflation in the February number, then that will be the trigger for that move. So we run barbell portfolios, 75% big tech, 25% domestic recovery stocks. Big tech is where you have 2% of the US workforce, accounting for 25% of the stock market capitalization and an incredible 25% of U.S. earnings. You always want to be in the industry where earnings growth is 10 times the workforce, and that is the case in technology. And then the domestic recovery stocks include railroads, airlines, cruise lines, couriers, steel companies, banks, commodities, construction, credit card companies, hotels, casinos, and online ticket sales. This has been one of the lead domestic recommendations that we've had since October. Boeing is practically doubled from the October low. They had a massive recovery in airline orders, and China has started flying their airplanes again after a 4-year vacation. It's at 209 now. We are targeting 250 sometime this year by Boeing on the dips, if you get one. And as you can tell, there aren't a lot of dips in Boeing. Just let me unplug this phone. And let's see. So yeah, buy Boeing on dips. JP Morgan financials will be big winners this year, and you can see they've already started moving in a major way from the October low, up 35%. We're targeting $200 this year for Boeing. They are the quality value play. They love rising interest rates, falling default rates, economic recoveries, and they're moving into online banking and closing their expensive branch network with incredible speed. Visa is another touchless payment play. It's catching exploding online commerce. Also is a nice reflation play. As soon as their customers raise prices, that feeds straight into higher fees for Visa. We traded at 224 yesterday. Look for a little pullback from here, and then we're targeting $300 per share sometime this year. Union Pacific, if you have an economic recovery, and that's what you're looking for now, are recovery plays. Remember, stocks move 6 to 9 months before the actual economy does. You have to move around a lot of big stuff, and no one is better at moving big stuff than Union Pacific. They're also a big China play because they're the main east-west route, moving oil and food back and forth to China. This is essentially a technology company now. It's not your father's railroad. We're looking for $300 a share for Union Pacific. Federal Express, not only do you need to move big stuff in a recovery, you need to move small stuff, and FedEx is the way to do that. After a big earnings shortfall in the fall, it created this massive gap down. We've been rallying ever since. We're looking for $300 a share sometime this year, and that's an increase of about 50%. Berkshire Hathaway is the one-stop barbell portfolio. They have a lot of banks. They're also the largest outside owner of Apple. They bought $25 billion worth of their own stock last year. We're targeting $400 a share in 2023, up another 100 from here by Berkshire Hathaway. Second half of the portfolio bets on a massive drop in interest rates this year and a global recovery to begin later this year. Upside potential for recovery stocks in 2023 is far greater than for tech. Some of these have not moved for 5 or 10 years. Focuses on economic cyclical industries, makes a great counterweight to high growth technology stocks, which we will talk about next. We could spend years rotating back and forth between the two groups. NASDAQ, looking for a big comeback there. We've been bouncing along a bottom since October, but now tech stocks have taken off like a rocket. I expect us to fail right around the 200-day moving average pullback, but after that, you're looking at new highs, possibly a 40% gain in NASDAQ sometime this year. Microsoft is an accelerating economy, means more PCs and operating systems. They're expanding their presence in the cloud with incredible speed, moving to subscription services. So we almost have a head and shoulders bottom developing here. You can see shoulder, head, shoulder. It's ready for a breakout. I'm targeting 350 this year. That is also about a 50% gain this year. You want to buy Microsoft on dips. Apple is another one that's been downtrending for the last year. We think the bottom may be in at 125. I'd be looking to buy dips from here. We're targeting $200 for Apple. There's a generational upgrade going on. 1 billion people need to buy phones to replace older generations so they can take advantage of 5G. So we're looking for a recovery in Apple earnings and really no losses throughout this entire economic slowdown. Amazon will be the first $3 trillion company, global online sales presence, AWS, advertising, streaming, healthcare. And if you break it up, it doubles in value. So there's a screaming buy down here for Amazon. We're looking for 185 this year. That's nearly a double off the bottom by Amazon on dips. Google, it has 92% of the online advertising business, which virtually shuts down during recessions. And you can see that in the share price. We got a low as 82 back in November, but we're looking for a recovery, which has started to accelerate in the last few days. We're targeting $150 a share for Google, buy on dips. Salesforce, another stock, just very early stages of recovery. They dominate in customer relationship management, laying off their excess labor like everybody else has, and they are set to grow exponentially. We're targeting $250 a share, which is a double off the bottom by Salesforce on dips. Tesla has really been hammered in the last year. We've been in this since the early days, back when it was a split adjusted $2 a share. They cut US prices. That greatly increases the losses for all their main competitors like Ford, GM, and Volkswagen. And it now qualifies their cars for the $7,500 tax subsidy. So when you work that in, it amounts to a 35% price cut for the end customer. This has absolutely floored the competition, crushed the used car market. Of course, everybody at the end of who had orders in the end of last year have canceled them so they can take advantage of the lower prices. It's already moved up 47% off the low from the beginning of this year at 101. I'm looking for 250 this year. It's an easy double. Also, you get Elon Musk out of the market as a seller. That takes pressure off the stock as well. We've made a ton of money on this. We're also recommending LEAPs or long-term equity participation securities for Tesla. If you want to find out what that is, sign up for the service. Bonds seem, we're looking like a great trade for this year until we got a new House of Representatives where chaos reigns. Treasury Secretary warning of coming U.S. bond default, saying the government runs out of money by June, capping prices for the foreseeable future. Overweight bonds, 60% of a balanced portfolio, says my friend Jeff Gunlock. That's a 60-40 portfolio, 60% bonds, 40% stocks. TLT should reach 120 in 2023 without political interference. That may happen in the second half of the year. So we may well chop in a range while chaos in Washington reigns supreme, and then go straight up after that. So keep buying TLT call spreads and leaps on the big dips, and we're having one of those now. You also want to buy junk bond ETFs, the JNK and the HYG. And of course, another major positive for bonds this year is that the US budget deficit has just dropped by half after the sharpest decline in government spending in history. Went from 3 trillion deficit to 1.5 or 1.4 trillion. That is not a bad return and is very positive for bonds. So here's the TLT chart. Of course, we were short for 2.5 years going into the October turnaround. Since then, we've been playing on the long side with a triple long position every month. And we see another dip down to the low hundreds. You want to load up there, and eventually we do break out to 20. And this is the yield chart. We see one more run back up to 3.9%, the 10-year U.S. Treasury yield, but then after that down to 2.50 or even 2% by the end of the year, depending on how fast inflation falls. Foreign currencies, the dollar is done. It has hit a 10-year peak. You want to be selling every dollar rally from here on and buying every currency dip. Japan inflation hit a 41-year high, exceeding the central bank's target for 9 consecutive months. Expect another interest rate rise in Japan, causing the yen to spike to a 4-month high at 128. Japan is reversing 30 years of easy money policy because it didn't work. They don't have to raise interest rates to keep their currency competitive with everybody else. And of course, weak currencies are highly inflationary. So the way Japan stops inflation is by raising the value of the yen against the US dollar. So in this scenario, you want to buy the euro, the Australian dollar, the British pound, and the Japanese yen. I'd give a pass on the yuan for now until their economy starts to recover from the China lockdowns. Strong currencies will also deliver major bull markets in emerging market stocks, which will probably outperform the US stock market by a factor of 2 to 1. Okay, Aussie dollar, I'm looking for 1 to 1. That's about a 30% gain from here, 35%. They are a major call option on the recovery of the global economy with all of their iron ore, coal, uranium, and food exports. This is your play on a global synchronized recovery. And I'm looking for a recovery in the Japanese yen, at least another 25% to go this year. Again, they have to strengthen their currency to fight inflation. And the euro, despite having World War III on their doorstep, we're seeing a big recovery in the euro. It's already recovered 10%. Looks like we'll get another 25% more by the end of the year. And we're looking for a strong British pound. By the way, is the new pound with King Charles III on the new pound coin, who I had the pleasure of meeting about 40 years ago at Buckingham Palace. Emerging market currencies will be the biggest gainer, looking for a 40% year. They're coming off a 10-year bear market. This is the big play in currencies, in bonds, and in stocks, for that matter. You could do a triple play in emerging investments and do really, really well this year. Energy and commodities, that has become a China recovery play. It's no longer a Russia play or a Ukraine play. Chinese economic recovery is boosting oil prices off the back of COVID herd immunity, which they decided to adopt about 3 months ago without telling anyone. And of course, China is far and away the world's largest oil consumer and importer. So that has a major impact on prices, and which is why you may get a decent move in energy stocks in coming months. Russia, on the other hand, hit a 2-year low when priced in rubles. That set off a budget crisis there. Couldn't happen to a nicer bunch of people. The $60 cap on oil purchases from Russia is succeeding, and a lot of the oil China's buying from them is at $50 a barrel or less. China's only buying at deep discounts. Russia's losing $170 million a day from the price cap, or about $62 billion a year. That may not sound like much, but remember, the US economy is roughly 25 times larger than the Russian economy. So 62 billion adds up to a lot of money. There is a short-term play in oil equities here at the bottom of the range. US is now the world's top oil producer, followed by Saudi Arabia and Russia. And massive supplies from the US are what headed off Europe's energy crisis, that and a ton of wool sweaters. So oil, we've been, basically in a downtrend for the entire year, but we got this double bottom recovery in China. We may move up to the top of this range here. So oil is worth a trade here, but a trade only, because that long term, we still are in a major long-term downtrend in oil. as more and more of the economy goes green. Last year, 10% of all cars in the world sold were electric cars. That's up from 20 years ago. And cars account for 50% of all oil consumption in the United States. So this visit that we had 3 years ago to 0 and negative 37 in the futures market, we're going to see that again sometime in the future, probably not for a couple more years though. Precious metals, we have a new bull market here. Massive silver shortage is developing with demand up 16% in 2023 to 1.2 million ounces, with EV production increasing from 1.5 million to 20 million units a year within the decade. Its share of the market will rise from 5% to 75%. Solar panel demand is also rising. Buy silver and Wheaton precious metals on dips. And my next leaps will be for silver on the next dip. Gold will also be a good performer in 2023, with central banks, especially the ones in China and Russia, buying at all-time highs. Collapsing interest rates also will be the big story for precious metals. So gold has been on an absolute tear. We've been long the whole time. Buy gold on dips. It's just a matter of time before we hit the old all-time high in the metal at 2,200 an ounce. We're looking for gold and the GLD to rise about 30% this year. And if you like gold, you're going to like its largest producer even more. Barrick Gold, we put out leaps back here in October, and they have almost risen 500% since then. Keep buying Barrick Gold on dips. And we see at least another 50% move in Barrick Gold shares from here. Let's see. So if you like gold, you'll like silver even better, which usually outperforms gold at a margin of 2 to 1. And again, this is the play on electric cars and solar panels. So buy silver on dips too. And by the way, we're already up from 1650 to 2250. That is a 35% gain in silver since the October low. So don't play with matches. You could probably do okay just buying all the stocks I mentioned above and forgetting about them. However, the reality is that conditions for these companies change every day. They are all viciously competing, trying to put each other out of business. You don't get daily updates on the fundamentals, you could easily get wiped out. Today's big winner could instantly become tomorrow's loser. That's why you need somebody like me to guide you through the thicket to avoid an out-of-the-blue blow-up. I gained financial independence for life, and so can you. All of this can be yours. Discover how to make thousands of dollars a year in extra income. Go from complete beginner to seasoned pro in weeks. Learn how to quit your day job and trade for a living full-time. Trade from anywhere, anytime. Supplement your retirement income with the satisfaction of booking winning trades by the hundreds. The harsh truth is you really need my help. The majority of individual traders lose money. They lack the correct training and discipline to succeed. Most broker research suffers from grievous conflicts of interest. Wall Street is all about moving money from the uneducated to the educated. The easy solution to that problem is to get educated. Fidelity did a 20-year study and learned that their top performing investors were dead people. Why did dead people do so well? Because 80% of the time the stock market goes up, and if you're dead, you can't sell too soon. Or better yet, you can't sell market bottoms, which a lot of you did last year. You need a real pro to guide you through the market maze. The market is not monolithic. 95% of it can be completely ignored. You just need somebody like me to show you which part to pay attention to and which part to ignore. There are a few great sectors and a lot of awful ones. You can get a 10x return on the great ones, but get wiped out by the losers. Let a 50-year veteran steer you to safe waters. Let me sit next to you and guide your hand on every winning trade. This is our secret weapon, my Mad Hedge profit predictor, our Mad Hedge market timing index. It's an artificial intelligence-driven algorithm that analyzes 30 different economic technical, and momentum-driven indicators all day long. It took a team of mathematicians 1,000 hours of calculations to create this. Why do you need an algorithm? Well, why use a toolbox missing its most important tool? Algorithms have become so dominant in the market, you should never trade without one. It does the work of a seasoned 100-man research department in seconds. It runs real time and optimizes returns with the addition of every new data point far faster than any human can. Imagine a trading strategy that upgrades itself 1,000 times a day. Don't go to a gunfight with a knife. If you are trading against algos alone, you will lose. Algorithms provide you with a defined, systematic trading discipline that will enhance your trading profits. And I'm not the only one using algorithms. Some 80 to 90% of all current trading is algorithm driven. I was walking on the Miami waterfront a few years ago before the pandemic, and I saw this super yacht. Look what it's called, algorithm. Bet it's working for more people than just me. This is 3 years of profit predictor performance. You can see it generates lots of buys at market bottoms, lots of sells at market tops, buy, sell, buy, sell. It's like owning your own printing press for $100 bills. This is our 15-year performance. We've averaged for 15 years 47.22%. That is 2.8 times the S&P 500 over the same time frame. Richard made millions religiously following my trade alerts. He now spends his retirement restoring vintage aircraft and flying them over the California coast. Greg turned 100,000 into 1.5 million solely on my trade alerts. He bought a new home in Orange County, California, with Tesla solar panels, Tesla Powerwalls, and a Tesla Model 3, and still had enough money left over to send 3 kids to college. And here is my friend broadcasting from the Rockies.
Hi, this is Bob. I live in Denver, Colorado, and hiking on top of the Continental Divide. 9 months ago, I joined John's Global Dispatch Service and was so impressed with the profits I made that 2 weeks ago, while hiking in the Dolomites, I joined his concierge service. And in 2 weeks, it is 100% paid for it, and I couldn't be happier. Life is good. John really helps. The other day, I had a text message exchange with him regarding some concerns I had with TLT. Put spreads, he encouraged me to stay in. I did, and today they went out at 95% of maximum potential profits. And that's the way it works for me. I hope you all do well trading yourselves. Thank you.
So what do we do about all this? Well, stocks, you want to buy the next dip. Bonds, you want to buy dips. Commodities, buy dips. Energy, stand aside for now, but buy dips in individual energy equities. Currencies, you want to buy every foreign currency out there. Precious metals, you want to buy the dips. If you are not up 107.27% in the past 12 months, as I was, you are reading the wrong newsletter or following the wrong trade mentoring service. Up 107.27% over the last 12 months and averaging 47% a year. You get that kind of performance, you get to do things that other people don't get to do, like take the owner's suite on the Queen Mary from New York to England. Once you get to England, you can take the Orient Express from London to Venice. Warning, every dinner there is a black tie, so you better bring an extra tux for this part of the trip. And when you get to Venice, you get to go island hopping in your own private helicopter. This is the very long view and where the big money will be made. The 2000s and the 2010s were the hard decades for making money. The 2020s and the 2030s will be the easy ones as a global demographic wave brings on a new golden age. 85 million millennials will become big spenders over the next 15 years, while 80 million baby boomers, a drag on the economy, fade from the scene. That'll create an economic boom that will last another decade starting this year. We've seen all this before, from 1982 to 2000. The Dow average was up 20 times in 18 years. Are you ready for a replay? This is what happened the last time we had a demographic tailwind, exactly like the one we are having now. And if that trend continues, the Dow will go up 20 times from the 2009 bottom up to 120,000 by 2030. Yes, that sounds impossible, up 250% in 5 years, but we've already done 400% over the last 13 years. You take that, if you think I'm smoking California's most popular product, look again. On the 18-year chart, we're right here. We've already done 2/3 of the move. So we just need a little bit more than a triple from here to get up to my 120,000 target. Except this time it's different. Technology is hyper accelerating on all fronts simultaneously, and the pandemic greatly sped up the rate of change. The development of functional quantum computers means that computational ability is about to increase a trillion-fold at no cost. The world's major computational challenges will shortly be solved, such as weather forecasting and cancer cures. All major human diseases will be cured within 10 years. Live another decade and you'll have a shot at living to 150. Needless to say, barbell stocks dominate in this scenario and will account for the bulk of stock market gains in our lifetimes. The 90s had cheaper computers, cheap operating software, and a new internet. The 2020s will have 10 times this number of new technology drivers. So who'll show you how to play the next 90,000 Dow points? Sit with me, John Thomas, the Mad Hedge Fund Trader, and my Global Trading Dispatch. Discover how you can tap into the top performing trade mentoring service in the industry, up 107% in a year. Follow my research and market beating trade alerts and you will rake the profits in. Let a Marine Corps combat pilot steer you to big profits. We trade single stocks, options, and ETFs for global equities, bonds, foreign exchange, energy, commodities, precious metals, and real estate. And we trade all this long and short, looking to capture every move in the market. And this is a picture of me in my 1932 Tiger Moth in Cambridge, England. No, that is not the plane I flew in Desert Storm. Notice the design flaws: gas tank directly over your head and no brakes. That's why you can only land this on grass fields. This is a typical trading record for 1 month from our market timing index. You can see we bought the S&P 500, made 16% on that. We sold short US Treasuries, made 8%, bought the Russell 2000 for 14%, bought Amazon for 12%, bought Apple for 7%. We bought Biogen and then stopped out. We stop out of all losers very quickly. It's easier to dig yourself out of a small hole than a big one. And then we went on to another string of winners in Palo Alto Networks, shorting the Japanese yen, shorting treasuries, buying the SPYs, and buying gold. It's just a matter of time before barbell stocks break out to new all-time highs. Watch this space melt up going into the end of 2023. Get ready to start wheeling in those whoppers with Global Trading Dispatch as your guide. Yes, that is a 24-inch rainbow trout, which I caught in northern Nevada. This is how our market timing index works. It spotted a coming upside breakout in the stock of Tesla back in the ancient days when it was only at $66 a share. So we sent out a buy recommendation that looks like this. And it says buy Tesla at 67 or best. It's an opening trade. And with the 10% of your portfolio, you needed to buy 149 shares to get a $10,000 exposure. What happened? Well, it went up 63% in 20 trading days. Did we just sit around and pat ourselves on the back? No. We sent out a sell recommendation that said take profits. And this is what that looks like. It says sell Tesla at 109 or best, closing trade. On this trade, we made $6,258 in only 20 trading days. What did we do after that? Well, we kept buying every dip in Tesla all the way until it got up to 1,200. So yeah, we made a ton of money, and this is how some of our followers got spectacular returns. So let me give you, Tesla is the only stock we made money with. We in fact have a Hall of Fame of 10 baggers. We got a 10x on Zoom right after the company came public. We got a 10.6x on Lam Research, the semiconductor company maker. We got a 16x on NVIDIA, the graphics card maker. We got a 25x on Square right after they went public. And we bought Moderna before the pandemic because it was a cancer cure, and we got a 40x return on that. And of course, the granddaddy of them all, up 400 times for Tesla. And we are still trading Tesla. We loaded the boat early this year and made a killing on it. Again, killing after killing. So with my global trading dispatch service, you get instant trade alerts set out at market sweet spots, about 200 a year, and all the reasons to execute them. You get live biweekly strategy webinars like this one with an interactive Q&A, special reports on urgent investment topics, invitations to strategy luncheons around the world, more educational videos and webinars than you can consume in a lifetime, access to a 14-year database on investment ideas, searchable by name and ticker symbol. And I'll even give you the name of a good surfing camp in North Africa. Warning, it's a lot harder than it looks. This is the one-stop shop. Learn all you need for every level. Individuals who want to understand what is happening with their retirement funds, for people who want to learn how to trade for a living, get the financial education of a lifetime. It's for smaller institutions and financial advisors who can't afford an in-house research department. Get in before the next melt-up begins. This is part of our service. You get my global market comments in your inbox every morning before the opening. You also get my Mad Hedge hot tips, the 5 most important things that happen today and what to do about them. And this is what I'm not going to charge you for my service. I'm not going to charge you $100,000. That's what I charge my big hedge fund clients, and they're happy to pay because I make them millions of dollars. And I'm not going to charge you $10,000. That's what I charge my concierge clients who get my personal cell phone number so I can be their investment 911. And I'm not going to charge $3,000. That's the full price of what I'm offering you on my website. To only through this webinar, creating this product cost me millions of dollars. With the biggest customer service in the industry, running it cost me millions more. Here's the offer you can't refuse, just $997 for 6 months. That's a 66% discount to the website price. It's a limited time offer. We only take 25 new subscribers at a time, so we don't overwhelm the market with our trade alerts. So it's first come, first serve. I can't wait to make you a top drawer trader. Just click on the chat box on the right. And David, you should have that link by now. That'll take you to a dedicated sales page that is only available through this webinar today. Let me make the money for you to pay for your subscription. You make the trades, discover how an experienced hedge fund manager finds and exploits the best sweet spots in any market. $997 for 6 months. Buy now and you will instantly receive a trade alert with an extremely high probability of success that you can execute immediately and make some of the most serious money in your life. Don't leave good money on the table. 95% of these trades make money, and I'm checking the market right now. Ooh, and I see the orders have already started to pour in. Yikes, look at that. Let's see. Yeah, you can get into this trade alert at a really great price right now. All you have to do is subscribe to the service, and the trade alert will be in your inbox immediately. And if it's not in your inbox, look in your junk folder or spam folder. If you're a brand new subscriber, that's where they go sometimes. But then we'll give you directions on how to find the trade alerts on our website. And just to give you a tease, this is the chart going up to yesterday for the trade alert. You have to go through 1,000 charts to find one this good. Let me do the heavy lifting for you. What I'm not going to tell you right now is this a buy or a sell. You have to subscribe to our service to find out. So when you make millions of dollars for your clients, you get a lot of pretty interesting invitations. $5,000 cases of wine, lunches on super yachts, free tickets to the Olympics, and dates with movie stars, and I promise not to tell who. So it was in that spirit that I traveled to the famed World War II fighter station at Biggin Hill to meet Mad Hedge concierge member Peter Monk. Peter was a poorly paid pilot for Ryanair when he first signed up for my global trading dispatch. After doubling his money in the first year, Peter upgraded to my concierge service. Then the money really started to pour in. Peter plowed his Mad Hedge trading profits into restoring a 1940 Battle of Britain Supermarine Spitfire Mark IX in his backyard, begging, borrowing, and trading for parts all over the world. He eventually built his fleet up to 16 flying aircraft, which are today worth over $65 million. When Peter invited me to fly one, I jumped at the chance. It was a mild and blustery day over England when we took off and headed for the English Channel. Even though the plane was 82-year-old, we managed to brisk 250 miles per hour over the countryside, and when the plane was new, it could do 450 miles an hour. The Spitfire could outmaneuver any plane the German Air Force threw up against it. This particular plane is credited with shooting down 2 Messerschmitt Bf-109s, and it's easy to see how. We found a clear piece of sky over the white cliffs of Dover between 2 big fluffy cumulus clouds and commenced a full-on aerobatic flight test. Pilots always want to see what I can do with these old planes, and this time is no different. I executed multiple loops, barrel rolls, chandelles, lazy eights, Immelman turns, and wingovers, careful never to exceed the 1 limitation, or the wings might fall off. Spitfires can dive like crazy, and we dropped from 8,000 feet to 2,000 feet in seconds. Then it was back to Biggin Hill for a perfect 3-point landing and a pint of beer at the nearest pub. Let me make millions of dollars for you as well, as I have done for thousands of other followers over the last 15 years. I look forward to working with all of you. And sometimes people send me emails saying they get airsick watching this video. Unfortunately, if you've been a combat pilot your whole life, you're immune to air sickness. And there's the White Cliffs of Dover right there. Okay, 6 months for just $997. And click on the link to the chat box on the right. We know it's working because we've already gotten a ton of new orders, and we're going to hit that 25 limitation very quickly. And I just want to say thank you to some of the new subscribers. We have Daniel from Fairview, Texas, who's just come in. Thank you, Daniel. Check your inbox for the trade alert and go ahead and do it, because this is a good entry point today. We also have here another Daniel from Barberton, Ohio. Daniel, thank you very much. I promise to work hard for your money. And we have here Esmeraldo from Long Beach, California. Thank you very much. Check your inbox for the trade alert, and I can see we are almost at the 25 limit already on trade alerts. We've got another one here, Dario from Aventura, Florida. We have here Brian from Cork in Ireland, and another one just came in. Let me check that one out. Brian from Winter Springs, Florida. We're getting a lot of people from Florida today. Must have something to do with the weather. Okay, let me check another one here. And we have here Ryan from Honolulu, Hawaii. Thank you very, very much, Ryan. I think a visit to see you in person is in your future. Yeah, getting sick of this rain. 26 inches of rain in 3 weeks, if you can believe that. And we got Michael from Napierville, Illinois. And we have here Alan from Bokeelia, Florida. Wow, that makes 3 from Florida. Okay, so just let me take a few quick questions here. Here's one from Bill. It says, can basic beginners use this service, or is this only for professionals? The answer is we have a large number of basic beginners come in every month, and the service is aimed at people assuming they know nothing about the stock market, and everything is very simple, easy to read, and plain English. And it turns out the professionals also like reading things that are easy to read and in plain English. Let me see. Okay, let me go through these. Great job. Thank you very much. Thanks for your service. LOL. And here's another one. Do you trade options as well as stocks? Answer is yes. Every trade alert we send out has your choices to buy either the stock, the option, or the ETF. You can do any trade you want depending on your level of experience and risk tolerance. But I can tell you that the big money is made in the options market. That's where the risk reward is overwhelmingly in your favor, especially if you have a professional like me backstopping you on every trade. Okay, let's see. We have any other questions here? Okay. Okay, let me check the order, the inbox again. We have Peter from Shreveport, Louisiana. We have Judy from Memphis, Tennessee. Thank you very much, Judy. And we have Seth from New York City, who's just come in. Okay, and I can see again, David has posted the link to the chat box for people who want to get the last couple of slots only. Okay, and any other questions? Okay, well, David, I think my time is about up. Are you ready to take the screen back?